All right, today on In Case You Missed It, Uber officially went public. We're going to give you a little IPO history for you. All right, since 2012, there's been a similar pattern in big tech IPOs with the stock price on the first few days, and Uber got affected by what happened with Lyft in that pattern. Let me run you through some stuff. 2012, Facebook went public at 38 a share, but the stock ran up to 45 a share, up 18% by November. That was May 2012. By November of 2012, it was down to 19 bucks a share. These things get overbought. We know that. I'm going to give you some trends here. So that's one. Boom. Snap, March of 2017, went public at 17 a share, rose to 27 a share. That's been a disaster. That was up 58% that day, went down to 11 a share in August. All-time low is below 5 bucks a share. And we know Snap has had problems with, hey, we're talking about Facebook here, had problems with Facebook. Lyft went public at 72 a share a few months ago this year, 2019, rose 20% to 87 a share, now down to 53%, and that's partly tied to Uber today, which brings me to Uber. Okay, the NASDAQ is hot. The market is hot. The NASDAQ's up about 18% year to date. Lyft went public when things were still risk on. Now we're starting to get a little risk off for several reasons out there. Uber wanted to price around 45 a share. They priced around 43 a share and hovered around 42, 43 all day. Actually low volatility for this growth tech stock. They're supposed to be volatile. There's not a lot of hunger out there for growth tech right now, and Uber went public after Lyft ran up and came down. Kevin Curran, Real Money, premium site. Kevin, you've been on Uber all day.
Yeah, so I think this is kind of a consequence of bad timing. One of these things is you're hitting the market as tariffs come in. People are fleeing the market in May as they usually do. And maybe Uber's saying to itself, we should have gone public when Lyft did because there might have been more positivity. Now that we've had however many companies hit the market with their S1 filing saying we're not sure if we're ever going to be profitable, we can only take so many of those that people are going to buy into, and there's almost no appetite for Uber today.
Yeah, and so one of the things we're looking at for Uber and Lyft is when are they going to be profitable, and it's going to take a long time to get there. We have 4 analysts on Uber. It's tough to do research today. I know you've been on it. What's the sense? I mean, it's going to take a long time for Lyft, but for Uber, what's the sense?
I think they're putting it out into the mid-2020s because, I mean, when you're losing billions of dollars a year and you're garnering rides when you're trying to garner customers by saying we have a lower price than our competitors, it's not really economical. And you're losing money consistently to build up that market share to wipe them out. The long-term strategy is that you build up the rider loyalty, you wipe out Lyft out of your competition, you got the global footprint, you look at maybe freight, you look at Uber Eats, and then potentially even autonomous driving in the long term. That all kind of pales in comparison. But for right now, the ride-sharing business itself is not looking like it's going to be profitable when you got 70% of your dollars going to paying the drivers, and then you got people paying lower prices on however many types of deals you need to do to bring those people in and continue using your product, rather than a lower cost alternative, hypothetically like a Lyft, or even some of the smaller players like Via or Get.
All right, if you want the rest on Uber's IPO Friday, that's your man Kevin Curran, Real Money.